so excited for today's webinar titled 2025 Market Outlook, Rational Exuberance, the question mark at the end. And I know that the team that we have assembled here is going to be going through the entirety of the outlook that can be seen over 2025. I'm Kristin Myers, editor-in-chief of ETF.com, here again with the team from ProShares. So I want to quickly start the slideshow that we will have for you guys in today's presentation. Okay, so first, a few housekeeping notes. So if you have any questions at all throughout this entire webinar, please email webinars@etf.com. We'll be sure to incorporate them as a part of this webinar a little bit later on in the programming. Now, for anyone that has to jump off or wants to view this a little bit later, taking notes, a recording is going to be made available on the etf.com website. Now, we're going to have you self-report if you would like CE credits. They are going to be available for today's podcast. I won't read out all of the available credits, but they are there on the screen for you for what credits you can receive after this program. So here's the agenda for today's hour-long session. We're first going to be talking again about the 2025 market outlook, looking at equities, fixed income, and then, of course, talking about equities and fixed income before going into a Q&A. And with that, I would like to turn it over to a member of the ProShares team. That's Troy Goldstein, Executive Director of Distribution and National Accounts at ProShares. Thanks so much, Troy, for being here.
Thank you, Kristin. Before we jump in much further, I'd like to introduce the rest of the people that you're seeing on your screen, my colleagues. As mentioned, I'm Troy Goldstein. I joined ProShares in 2011. I am the Executive Director heading Distribution and National Accounts. In that role, I oversee our sales team as well as heading up national accounts for the full lineup of both ProShares ETFs and ProFunds mutual funds. I'm excited to be joined by several members of our esteemed ProShares investment strategy team today. We're going to kind of take us through today's presentation for the most part. First up, Simeon Hyman, Global Investment Strategist and Head of Investment Strategy. I'm sure many of you recognize Simeon. Simeon is a familiar face. He's a regular on multiple media outlets, including CNBC, as well as Bloomberg. You name it, he's been on it. Simeon leads a team of investment professionals, and among their responsibilities, they provide education to the investment community, including through the development and publication of research white papers and much more content. We'll also be joined by Kirwan, Director of Investment Strategy at ProShares. Kieran joined us in 2013. He is responsible for portfolio analysis, education, product research and development, and the presentation of investment strategies utilizing ProShares ETFs, and is often seen side by side with our sales team, and is a huge resource for us. Next up is Bryan. Bryan is an investment strategy analyst here at ProShares. Bryan joined ProShares in 2022 and is also responsible for portfolio analysis as well as the presentation of our investment strategies utilizing ProShares ETFs, and also he does a lot in the product research and development area for us as well. Last but definitely not least, we'll be joined by the newest member of the team, Rufus Rankin, Director of Investment Strategy here at ProShares. Rufus joined ProShares in 2024, and is similarly, he's responsible for the presentation of our investment strategies utilizing our ETFs. However, Rufus also conducts extensive research and analysis for ProShares, publishing investment white papers, and also supports the firm's policy initiatives. As you can see, we absolutely have a jam-packed agenda that Kristin took us through, and we've got the right people to cover the topics that we're focused on today. So I truly believe that they will bring incredible insight, and this will be a very timely discussion. If we look at, before we kind of jump in, I'd love to do kind of a quick 2024 review and kind of preview what we're going to talk about. If we look at 2024, the U.S. economy kind of showed robust growth, supported by stable inflation and a resilient labor market. What this fueled was it fueled a very impressive stock market performance. If you look at it, where the S&P 500 index gained about 25%, the NASDAQ 100 index rose about 26%. But as you know, the past 2 years have really been driven by that quote unquote magnificent seven tech giants, right? The big magnificent seven, as they've been referred to over and over and over. However, this strong performance also led to elevated valuations and increased market concentration across a very limited number of companies, thus the name seven. Uh, During 2024, what we witnessed was, continued and new global unrest throughout the world. We also had this little thing called an election here in the US. And who could forget all the constant advertisements every time you turn on your TV? And in the end, the election resulted in quite a political shift, with the Republican Party securing both the presidency as well as the House and Senate. With any change in leadership comes uncertainties, and as it pertains to policy and in turn market dynamics and so much more. So if you think about it, you can kind of summarize what could be in play in 2025. It could be tariffs, it could be deregulation, it could be tax cuts, it could be all three as a result of that shift. So now we move into 2025, and there are so many questions out there, around the market and what we expect and the expectations across the equity market. Do we expect shifts? Where do the opportunities lie? And that's what we hope to hit on in today's call. So before we turn our attention to 2025 and our outlook, I thought it'd be interesting to kind of throw the first question out to our audience and see where their thought process is. So if we pull up our first polling question there, all right, there it is. Perfect. So my question to all of you is, where do you see the highest opportunities for the year ahead? You're only going to select one of these. So again, your choices are U.S. large cap stocks, U.S. small cap stocks, international stocks, U.S. government bonds, or U.S. corporate bonds. Again, you're only going to pick one. So where do you see the highest opportunities for your clients and for the investing population for 2025? All right. Again, those choices are U.S. large cap, U.S. small cap, international, U.S. government bonds, or U.S. corporate bonds. All right, let's go ahead and look at our results here. And if I look very quickly, it looks about 46% led by U.S. large cap stocks. And if you look at the three on top, it accounts for all but 5%. It accounts for 95% of your results are in the equity markets, whether that's U.S. large cap, followed by U.S. small cap, and then international with a lesser degree. So I think that kind of sets the tone for where we want to talk and where we want to start. And I'm going to kick it over to Simeon Hyman and bring him in for his insights on the 2025 market outlook, rational exuberance. Simeon.
Thanks so much, Troy. I think you're going to find us a little bit aligned with the poll. Folks are clearly feeling a little bit better about the stock market than the bond market, and we're going to more or less agree with you. But let me walk through the rationale here, which we do call rational exuberance, to be a little bit of a play on good old Alan Greenspan's irrational exuberance from 30-odd years ago. And yes, there are a whole host of things that you can read about and hear about all day long with regards to the change in administration, the regulatory outlook, fiscal policy, tariffs, all that. We want to zoom in on one point that I think is very important, but not talked about enough. And that is a very important shift in the construction of the companies of the S&P 500. And that is a dramatic drop in the amount of debt or leverage in the S&P 500. It is actually pretty astounding. We are looking at net debt to EBITDA as the classic measure. It has come down well more than half, from somewhere around 4.5 times to somewhere around 1.5 today. So we have dramatically less leverage in the S&P 500. Now, less debt automatically means less risk. So we can talk about that as a risk element, but on the next slide, there's something even more important that this more modest level of debt tells us. And what we can see on the next slide is that it tells us something very important about the underlying profitability of the S&P 500. You will most frequently hear folks talk about the return on equity for the S&P 500. And you can see in the lighter colored bar, that has improved a little bit over the last 20 years. But the math here is straightforward. If you're achieving that return on equity with just a fraction of the leverage, that means the underlying unlevered or return on assets of the S&P 500 must be dramatically higher. And in fact, it is to the tune of roughly 4x. The underlying businesses of the S&P 500 are 4 times as profitable as they were 20 years ago. That, even in the face of a 25 times PE, is how we get to rational exuberance. We can't get away from a little bit of exuberance. There's still 25 times, but with quadruple the profitability, there is a basis for it. Next slide. We've also got history to give us a little bit of a bullish feel too, and that is that despite the robustness of the market's performance in the last couple of years, by historical standards, we're only halfway through. Whether you look at it on a calendar length basis or whether you look on it on a total return basis. And again, history may rhyme, it doesn't repeat. However much stock you want to put in this, that's why we started with the fundamentals of leverage first, but we also wanted to share a historical perspective. So from both of those aspects, there's breathing room here, perhaps a little more than you might think if you're just looking at that headline PE multiple. Next slide. Now that contrasts with the fixed income markets. Now, before we even talk about credit, which is on this slide, of course, there's the issue of sticky inflation. For those who've been watching the tape, we had a little bit of a benign number this morning, and then last week we had a number that was a little challenging. Let's park that for a second. We're going to talk about that. But before we even get there, we wanted to talk about these corporate bond spreads. Now, the funny thing here is we just said that the S&P 500 has dramatically less leverage than it did. So you might say that tight credit spreads, and look how tight they are. This is versus the 20-year average, we're talking about less than half. You might say maybe that's okay, because didn't I just tell you that leverage is much lower, therefore risk is much lower? But the problem is that these spreads are priced for what we might say is almost beyond perfection. And why do we say that? Because if you look at high yield as an example, that 20-year average is about 5%. Now, historically, defaults have subtracted 2 or 3% from that 500 basis points of spread, meaning that after accounting for the modest loss from defaults in the high yield market, you would net out somewhere around 300 basis points of extra spread. Today, the high yield bond spread is less than that 300 basis point number, which means that if there are zero defaults in the high yield market, you will do worse than you did historically after accounting for defaults. That would be the definition of price for beyond perfection. Next, we do talk about the question of inflation. And here on the next slide, what you'll see is first one way to look at it, which is in the context of inflation. Now we had in the fall 10-year bond yields that ranged from about 4 to 4.5%. What we're suggesting is that that was pricing in the Fed's stated target of 2% inflation. 2 plus 2, 2 plus 2.5, 4 to 4.5% of a yield on the 10-year bond reflects a 2% ultimate achievement of inflation. And here, we actually put this slide together before Chair Powell spoke in the fall, and we said, listen, what if we're wrong? What if inflation sticks at 3? Well, then the 10-year bond yield will go north of 5%. And lo and behold, Chair Powell showed up in December and said, you know that 2% thing, we're not quite going to get there. He actually said out loud, I think we're going to get to 2.5. What's halfway between 4.5 and 5.5? 4.75. That's exactly where the 10-year is today. What we're suggesting is the market reacted perfectly to Chair Powell suggesting 4.5%, 2.5% inflation, which puts us right in the range of about a 50 basis point increase in yield from where we were. And on the next slide, you can see the same math applies to Fed funds. If it's a 2% inflation rate, you can expect a 3% terminal Fed funds rate, and then 150 basis points on top of that, which is the typical term premium, gets you to 4.5. With a 2.5% endpoint for inflation, Fed funds probably only gets to 3.5, not 3. Guess what? That's super close to where Fed fund futures and expectations are. Either way you look at it, we are now in a more or less equilibrium on inflation, expecting just 2.5%. We would suggest, though, that still the risk is for a little bit more sell-off ultimately on the long end. So from both a credit spread perspective and an inflation perspective, we're a little bit more bearish on bonds than we are with regards to the rational exuberance of stocks. Now, you need to hold two truths in your heart simultaneously in this environment, because while the base case is for a robust economy and a touch more inflation than the ultimate Fed target, it is true, though, that bonds can do a job they have not been able to do in a generation. So you have to have some bonds. What are some of the most important bonds you need to have? Regular duration bonds that can go up if the equity market goes down. With a 4.5 to 5% yield on the 10-year Treasury, if something goes wrong and we don't have this strong economy with a smidge of extra inflation, but we have a recession and the equity market corrects 10 or 20%. For the first time in a generation, the 10-year bond yield could go down to, say, 3%, and you could make 10 or 15% on your bonds. This already happened just for a millisecond this summer. The equity markets went down 10% for about a week, and the aggregate bond index went up 7%. This is super important because now that quantitative easing is over, the 10-year bond yield is not 50 or 100 basis points. Bonds can do their job. Very important. That means that asset allocation can work again. A 60-40 portfolio can do its job. And finally, just on the crypto point, look, there's so much talk about Bitcoin. What we wanted to point out, again, is just one thing that maybe people aren't talking about, and that is that Bitcoin really can be a diversifier. So many people have suggested that Bitcoin is just another risk asset correlated with stocks, to which we'd say that's not really what's been happening. The correlation with the S&P 500 is quite low. The correlation with bonds is low, and the correlation with gold is low. If this surprises you or you're skeptical about this, go back to the regional banking crisis that actually put several crypto-related financial firms into bankruptcy and pulled down the equity market and the financial services sector. Bitcoin went up when there was a 15% correction in the financial sector and a decent correction in the S&P 500. And with that, I will hand it back to Troy.
Thank you so much, Simeon. You touched on so many different areas of the market, talking us through kind of where the opportunities and risks may lie across the investing world. Now, before I bring in Kieran to cover the next section, let's turn our attention back to our audience for a moment and throw out another polling question around kind of where you're turning for your client's income. So remember, this is about income. So what equity income strategies are you using or considering to use in 2025? Is it REITs? Is it MLPs? Is it high dividend yielding stocks? You can answer more than one on this one. So you can answer all five. You can answer a combination. So is it high dividend yielding stocks? Is it dividend growth stocks? Or is it covered call strategies? Again, you can have 1, 2, 3, or 5 choices here. But again, those options are REITs, MLPs, high dividend yielding stocks, dividend growth stocks, or covered call strategies. All right. And it looks like our numbers are still coming in. So there we go. So it's led by dividend growth stocks, but not far behind it are high yield stocks as well as covered call strategies. And I think that's that kind of leads us right into what Kieran thinks. So Kieran, let me ask you to jump in here and provide some insight as it pertains to our equity outlook. Kieran?
Fantastic, Troy. Great to be with everybody. We kind of gave you the preview there with Simeon's portion of the call here, that we are, of course, favorable and relatively speaking, constructive on the equity markets. There's some nuances here, so I'm going to get into some of that detail. So if we can move on to the first slide here, let's talk about maybe the one concern that's likely on most people's minds as it relates to the equity markets, and that's been, of course, valuations. Some may call them robust, some may call them frothy. There's certainly been a narrative out there that valuations will be a little bit more in focus with some of the yield backups that we've seen over the last couple weeks here in 2025. But I'm going to give you maybe 2 or 3 things to think about. Number one, of course, right, we all know that valuations are a little bit excessive or stretched for some of the headline indexes. That doesn't apply, of course, to all parts of the equity markets. We'll give you a few things to think about here into some other portions of the equity market where there is perhaps a little bit more opportunity. Point number 2, remember valuations in the near term. Well, let's go back to that slide. I'm sorry. Let's stay there. Point number 2 on this slide is that valuations over the near term tell us virtually nothing about what happens to the stock market performance. So it's certainly not a catalyst. Longer term, yes, you could argue that they become more valuable, but not really much timing value in pure valuations now. But number 3, and that's what we're speaking to at this slide, stocks have an opportunity to grow into some of these valuations. And that's notably different than the market we saw in 2023, when the market delivered 0 earnings growth. 2024 will actually, when all is said and done on the large cap side, deliver about 10% earnings growth to the market. 15% expected into 2025 for large caps. But I'm going to draw your attention to the center and the right-hand portions of this slide, which is the mid and small cap portions of the market. You can see after some negative numbers that we're ridding ourselves of in 2024, the market is really expecting an earnings acceleration for those portions of the market. One of the reasons that we in particular like that mid-cap portion of the market. I'll get to more of that in a moment. Next slide. So we saw with the poll question, and thanks very much for some of the dividend growth loyalists out there. We, of course, think of ourselves as the leader in dividend growth ETFs. We have the largest lineup of dividend growth products in the marketplace. So dividend growth is always near and dear to our hearts. Hasn't been the most in favor portion of the market by any means over the last number of years. Still have delivered fairly solid returns, but in a market that's been dominated by momentum and growth stocks. Some of those dividend growth strategies have been lagging the market, even though their long-term numbers suggest that they do just fine. I'm going to give you just one thing to be a little bit optimistic about. We went back into history. We like the whole history rhymes, may not necessarily repeat, but rhymes line. So we wanted to show you how the aristocrats, that's the S&P 500 dividend aristocrats. These are the elite group of companies that have grown their distributions for on average 40 consecutive years, right? These timeless names. They tend to do quite well after the Fed begins to cut rates. We know that the Fed began their rate cutting cycle now in September. We have seen some green shoots of outperformance, certainly since about the midpoint of 2024. So this is good reason to believe that, again, this idea of higher quality dividend growth stocks may be able to deliver more consistent earnings growth. And you can see there that they've actually outperformed, at least historically, both high dividend yielders and the market itself once the Fed begins to cut. Next slide, we give you maybe a slightly different view of this whole question about rate cuts. How do stocks do after the rate cutting period ends? Well, this slide gives a little bit of insight into that question. And we will note here that we're probably not expecting so many cuts this year, right? Maybe 2. I think the market has priced in 2 cuts for 2025, perhaps starting as early as the March Fed meeting. So we'll see what happens on that front. But we do know that once the Fed is done with their rate cutting cycles, which may be a little bit sooner than earlier anticipated, certainly all stocks do well. But look at those 2- and 3-year numbers. The stocks that tend to do even better than the large cap space are, again, mid and small cap stocks. So that's an important historical lesson that we've seen. And after all that underperformance that we've seen, we do feel that mid and small cap stocks, especially of the higher quality variety, are certainly well positioned. Let's move on to the next slide and talk about really the second leg of our equity outlook, which is this idea of broadening market participation. I noted that a few slides earlier. We think this is a theme that can continue to run with a caveat. Our advice is always to stay high on the quality ladder. We know there are a good chunk of those small cap companies that don't make any money. We like to invest in companies that are resilient, that are higher quality, have better balance sheets, can deliver better earnings growth. We find those, of course, in our mid and small cap dividend aristocrat type of solutions. We've noticed now, again, this data is going only through November. We gave away some of this outperformance in December, but certainly these are the green shoots that I was referring to, especially in that mid and small cap portion of the markets, actually outperformed what previously had been driving the market, which is, again, those momentum-oriented, growth-oriented stocks. Even the tech sector writ large has underperformed the mid and small cap dividend aristocrat strategies. Again, look, this is a key indicator from our perspective. Look for this to continue to run. Lots of room on the valuation side and the earnings side for small and mid to continue to lead the market. Next slide is really where I'm going to end my comments, which is around the third leg of our equity outlook, which is that we feel equities are really the better place to be looking for income these days. My colleague Bryan will talk about fixed income markets in a little bit more detail here in a moment, but as Simeon referenced, we think there are a couple of headwinds facing fixed income investors. Yes, yields are normalizing a little bit, and you can certainly derive more levels of income in the fixed income market. But a better place, arguably, in our view, is from the equity markets. Now, we know that there are some covered call enthusiasts on the call. That's fantastic here. Just understand that the so-called traditional covered call products that are really, really popular these days do come with a pretty significant trade-off. That's what we're speaking to on the left-hand panel of this slide. You can see here we've overlaid the S&P 500's performance with the traditional monthly covered call benchmark there. And you can see how much total returns those strategies have foregone over the years. That's a huge equity market give up. We even saw this in 2023 and 2024 as equity markets have continued to rally. There are better options available in the covered call space now, specifically products now that utilize daily options, and that's what the right-hand side of this slide is showing you. So a great benchmark to look at, the S&P 500 daily covered call index. We certainly here at ProShares have a product that's benchmarked against that index that uses daily options, allows you, as you can see here, to capture most of the returns of the equity market with a double-digit yield. So that's a great opportunity from our perspective if we're constructive on equities, and we certainly are, and we think that you can derive higher levels of income than you can in the fixed income market, and it can potentially grow with a dividend growth opportunity. That's the sweet spot for income, high income today, income growth for tomorrow, a very good opportunity. So the last slide here is just a summary slide. giving you, again, a summary of our equity outlook. We do think that we've got a little bit of room to run here with the equity market. Certainly today's reading on inflation is getting maybe some of that positive momentum back into the market. We think that an opportunity here to participate outside of large caps, stay high quality in your mid and small.
So, all right. Well, we seem to have lost Simeon there for a minute, but I think what he was basically saying, and I was glad to hear him say, he has a feeling that the bull market may still be in its early stages, and that there's a lot of upside potential. You heard him talk about dividend growth as a possible opportunity, as well as some other items within that equity place. And in fact, hopefully, what he was saying there, and part of his summary was that, investors could potentially harvest high levels of income that can grow over time with a combination of covered calls strategies powered by daily options. So there's a lot of opportunity out there in the equity market. And I think what you also heard him say was this could be a year where we see broader market participation, which I think is something that we would all welcome. So I want to turn back to our audience here for a moment. I promise this is the last polling question. But let's throw the polling question up there. What role, as we're going to make a shift now from our discussion on equities over to fixed income, what role do bonds play in your portfolio today? Is it that you're looking for capital preservation? Is it that you're looking for income generation? Is it just using it as a diversifier? So again, where do you typically utilize bonds as you're kind of building out portfolios for your clients? Is it capital preservation? Is it income generation? Or is it diversification? Or is it a combination of all three? And it looks like from our audience, we are kind of seeing diversification slightly over the other two, but not far behind. Over 42% of our audience saying capital preservation as well as income generation. I think that kind of sets the stage for where I want to shift gears and bring in Bryan Gao for the other side of the investing world. So, Bryan, if you wouldn't mind providing some insights on our outlook for the fixed income world. Bryan?
Yeah, thank you, Troy. As you said, interesting results. Number one is diversification, but overall pretty close results. So with that, we'll go into our fixed income outlook for this year. 2024 was another positive year for fixed income, and a couple of interesting things happened at the same time, right? The Fed cut interest rates by 100 basis points starting from September till the year end. And the 10-year actually increased by 69 basis points over the year. Despite this increase in yield, though, the aggregate bond index was positive over the year, and the high yield index returned over 8%. The reason, of course, is credit spreads have narrowed, or the difference in yield between corporate bonds and treasury bonds narrowed. Let's take a look at that at high yield, since it's especially true for lower rated credit last year. So in the chart on the left, the darker blue line was the overall high yield credit spread. It was already at the post-financial crisis low at the beginning of last year, and it tightened further to a new record low. And specifically, this tightening is driven by the difference between lower rated bonds rated CCC or lower. And you can see in the green line, the brighter green line, which is the difference between CCC rated spread and the next higher rating, the single B rated spread. This difference of CCC minus single B spread dropped sharply, especially in the second half of the year. Now, if you look at the table on the right, all three credit ratings are at or near their post-financial crisis tights. As shown here, we have very close to historical tights, even in the CCC rated bonds after what happened last year. This doesn't necessarily mean that spreads will widen again or price will fall, but it does mean that there's just more that can go wrong for investors who buy into these levels. And this is one of the reasons we think the mindset of investing in bonds today should start to shift from building income to one of building diversification. Let's go to the next slide. So here on the left-hand side, the dotted line was at the end of 23, and then the solid line was at the end of 24. As you can see, if we just look at the dotted line at the end of 23, that was an environment where there's a yield advantage for investing in the short end, where you could just focus on building income without much duration. Of course, the yield curve has shifted, as you can see on the left-hand side chart. So now that yield advantage has mostly disappeared. And that's one of the reasons we think the mindset should shift from income to diversification. As a side note, on the right-hand side, that's the spread curve instead of the yield curve. And that curve is still upward sloping. And that has contributed to the strong performance of rate hedge strategies last year. So a rate hedge strategy in investment grade, for example, returned over 9% last year versus just 1% for the Ag index. Next slide, please. So there's recently a lot of pressure for yields going up, but we think after the increase in treasury yields last year, it's already pricing in a decent amount of inflation, interest rate volatility, and it's appropriate for the post-QE world we're in today. And if we look at part of this chart, during the 2010s, for example, there was no real inflationary pressure. Central banks were conducting large amounts of asset purchases. And the dark blue line, which is the level of interest rate volatility, was low during that decade. So term premium, which is a component of long-term interest rate, was also low as a result. But now, if we look at the more recent period, so the term premium measures have been steadily going up. And we have two model-based measures here, and one from the San Francisco Fed seems to be consistent with the dark blue line, the rate volatility. So that's showing long-term interest rates have adjusted higher. Next slide. But of course, the elephant in the room is the pressure for yields going up. And we also think that's the key challenge heading into 2025, because we have a new government and new policies, including tax, trade, immigration, and so on. And they can easily bring new pressure for yield rising. For example, inflation pressure can come back. It was already on the path lower, but arguably settling around above the 2% target, as you can see in the left-hand side chart. And on the right-hand side, we're looking at the supply of the treasury bonds. This shows the ability for the US to service its debt as if it were a company. And if the US continue to expand the fiscal deficit by issuing more debt, that can lead to the market requiring or demanding higher treasury yield as a result. Next slide, please. So in addition to inflation and fiscal deficit, a hot economy can also lead to higher interest rates. We had a glimpse of that in the lead up to the election, where the 10-year yield increased over 80 basis points. And here you can see throughout 2024, actually, rate cut expectations moved really closely in line with simply economic readings, right? And this also impacts, of course, the 10-year yield, the dollar, and so on. So the economy is a key indicator to watch for where rates are going. If we go to the next slide. Yes, so here the light line is the soft data or survey-based measures of the economy. These include PMIs, consumer confidence, business sentiment readings, and so on. And if we look back towards the first term of Trump's presidency during 2017 and 18, during that period, the light line or sentiments were especially strong. We just lost the graphic for a second, but we can easily get a repeat of that kind of sentiment, which will put the Fed on a slower path to cutting interest rates in 2025. So in summary, short-term interest rates have come down. Long-term interest rates have seen the volatility going up. And then credit spreads have tightened at the same time. And all of this means the playbook of the last 2 years of building income in the short and intermediate duration bonds is less attractive now. Meanwhile, we think the tail risk of runaway inflation receded, so the bonds can play a more diversification role once again. We just need to be mindful of the policy risks because there are lots of uncertainties that can still push interest rates higher in the near term. Now I'll hand it back to Troy.
Thank you so much, Bryan. And I love the insight and the perspective, hoping that 2025 brings with it some more clarity, especially on the policy environment and the diversification role of bonds. So now we kind of roll it all together into a section that has my favorite title of the day. So I would ask Rufus to jump in here. Rufus, why should we let our stocks be stocks and our bonds be bonds? And what do you mean by that?
Hey, thanks, Troy, and hope everybody's still with us. I'll try and keep this lively as we're getting towards the end of the hour. Let's look at that next slide, please. So the challenge that Kieran highlighted with traditional covered calls is pretty straightforward. You're sacrificing a lot of that upside potential in order to clip that coupon, in order to earn those quarterly or even monthly yields. But there's another challenge here that I don't think is as obvious. So a lot of people that use traditional covered calls are aware of that trade-off. But a lot of times you also hear investors say, hey, you know what? I get some diversification benefit or risk reduction benefit from my traditional covered call allocation as well. Unfortunately, that's just really not the case. So we can go back in time to the global financial crisis, and we can look at how a few hypothetical portfolios would have done. Portfolio one is the traditional 60-40 portfolio, 60% US large cap stocks, 40% 7 to 10-year treasury bonds. Portfolio 2 and 3 represent an investor having a bad feeling about what's to come and saying, how do I adjust my portfolio to potentially try and reduce risk in this nasty crisis we're about to experience? So portfolio 2 shows the investor reversing that 60-40 portfolio and going 40% bonds, 60% bonds, 40% equities. Portfolio 3 is a different look. In this case, the investor says, I'm going to take a little bit out of stocks, a little bit out of bonds, and put that into traditional covered calls. So going from 60-40 to 50-30-20 with the 20% in a traditional covered call strategy. And unfortunately, as we can see here, that did not pan out or turn out well. We actually added to the risks and the drawdown suffered during the global financial crisis. So let's look at the next slide. Simeon used this as well to talk about something that investors everywhere have been feeling, and that is before quantitative easing, we could count on bonds to do a good to great job of diversifying our equity portfolios. However, after quantitative easing, we can see that that relationship that we used to expect to be negative had actually turned positive. Where did we see that in play? We saw that in 2022 when both equities and bonds had double-digit losses for the year. That's really challenging. So when you look at this, you can say, hey, it's okay. I can understand why investors would look away from bonds for good diversification of their equity portfolios. Let's look at the next slide. Now, both Simeon and Bryan have told us, hey, there's reason to be optimistic about bonds generally, and we can start to count on them again to serve that role of diversifying our portfolios in the future. And that is very good news. But let's look back at the global financial crisis again and do a Monte Carlo simulation. What this lets us do is say, if things had unfolded in a similar but different way, would it have always looked that way? Or was it just luck of the draw that traditional covered calls did not serve to diversify our equity and bond portfolios? So what we did was we ran 1,000 simulations of each of those 3 portfolios over the course of a year, using the sample mean returns, volatilities, and correlations from that global financial crisis period. You'll note the correlation between the S&P 500 and the S&P 500 traditional covered call index was over 90%. So we shouldn't expect a material benefit here, but let's do the simulation anyway. Let's look at the results, on the next slide. So on the left-hand side, we see the distributions of all 1,000 portfolio volatilities for each of those 3 portfolios. The first one is portfolio 1. The second one is portfolio 2. Again, portfolio 2 is 40-60. That's 40% equities, 60% bonds. And portfolio 3 is at 50-30-20, with 20% in the traditional covered call index. And we can see here, it wasn't just luck. The entire distribution of volatility, that is annualized standard deviation of those portfolios, is significantly different, with 40-60 being the clear winner in terms of being the smallest, and unfortunately 50-30-20 being the worst in terms of the outcomes or the simulated volatilities for this study. On the right-hand side, we see the drawdowns, that is the worst peak to valley loss for each portfolio over time. And we see a similar effect. We see that 60-40 was in the middle, that 40-60 had the best distribution of maximum drawdowns. It sounds a bit funny to put it that way, but the worst losses of all those 1,000 simulations for 40-60 had the smallest and tightest distribution. And then finally, again, unfortunately, the 50-30-20 portfolio with 20% in the traditional covered call strategy did not reduce risk. In fact, it increased risk. So to put a dot on that, unfortunately, traditional covered call strategies do not do a good job of reducing risk, especially when you have real drawdowns, real corrections, real bear markets. Next slide, please. So to wrap this up, what do we mean when we say let stocks be stocks and bonds be bonds? We want stocks to do a good job of capital appreciation and in some cases generating yield. We want our bonds to serve as our primary, if not only, diversifier. But let's not ask an equity strategy like covered calls to be a diversifier for the rest of our equity allocation or portfolio. So we can compare, in this example, two enhanced versions of the 60-40 portfolios that allocate 20% from the equity portion to covered calls. So we're still staying 60-40, but 20% of that equity allocation is going into either a traditional monthly covered call strategy, and we use the S&P monthly covered call index for the proxy for that, or we can use the S&P 500 daily covered call index. And we can see here that since inception of the daily covered call index, which was October of 2023, into December of 2024, our enhanced 60-40 portfolio that uses the daily covered call strategy had 3% cumulative outperformance relative to using the traditional covered call portfolio while generating exactly the same yield. So by enabling ourselves to capture the full upside or materially all of the upside of the S&P 500, this enhanced 60-40 portfolio was able to keep up with the standard 60-40 portfolio while generating the same yield as you would get using traditional covered calls. So that's my time. I'll say thanks and turn it back to Troy.
Thank you so much. And Rufus, you made reference in your discussion about a white paper. And additionally, we've had a few questions come in asking about tickers, especially around the daily covered call strategy. So I want to remind everyone before we get to our questions that at the bottom of your screen, you should have a resources tab. And in there, you'll not only find Rufus's white paper that he mentioned, but as well, you'll see an implementation guide will provide that ticker information or offering information that hopefully will help you as you move into 2025. In addition, you can always check ProShares.com website. And we will get to our questions now. And if we want to pop over a couple more slides here, obviously disclosure, but if you could keep the next slide up there. Yeah, well, we're talking through our questions. Let's make sure everyone has the information in case they have a question I don't get to, that they can reach back out to us and get that information either from our website, the phone number, or info@proshares.com. So first one up, Simeon, you've had a long enough break. I'm going to throw one of the questions out to you. If companies have substantially less leverage, doesn't that make tight spreads okay?
You know, Troy, it makes them better. But as Bryan spoke about for several minutes, and I hit upon it at the opening of our presentation, they're just so tight that they're priced for beyond perfection. And I think another way to think about this is also in the context of what if there's a little bit of sticky inflation? Well, okay, bonds get hit worse than stocks, arguably. Why? Because coupons are fixed, but earnings grow. There is a reason why folks say, you know, equities are the most important asset in your portfolio as your long-run defense against inflation. Can stocks take a little hit the day inflation expectations change? Sure, but over the long run, I really want earnings to grow. One of the comical things I hear when you turn on the TV is the following observation when you turn on CNBC or Bloomberg. The earnings yield of the S&P 500 is less than the yield on a 10-year bond. So I turn the PE upside down and I say that 25 times is a 4% earnings yield. That's worse than 4.75 on the 10-year. Irrelevant. The coupons don't grow, the earnings do. And that's another key reason why we feel a little bit better about stocks and bonds in this environment.
Sounds good. Kieran, here's one on dividend growth stocks. So dividend growth stocks have seen improved performance over the past 6 months. What reasons do we have to think that this trend may continue?
Yeah, I think it starts, Troy, with that notion that Simeon just hinted on, which is earnings. If we think earnings are going to really continue to drive this market, where can you go for arguably the most reliable type of earnings across the asset class market cap spectrum? It's in higher quality stocks like the dividend aristocrats. We know historically dividend aristocrat type of names have had more consistency in delivering that earnings growth. So we are favorable on those types of stocks, kind of fundamentally for that reason. But also, if you think about kind of some of this idea of mean reversion, we know that aristocrats have underperformed over the last couple of years. When we look at those valuation differences right now, the amount of discount that the aristocrats are trading at relative to the S&P 500 have historically been buy signals, right? Maybe not in the first year, but as you go out to years 2, 3, and 4, this is the time to be leaning into higher quality stocks. And so you got a little bit of fundamentals, you got a little bit of a signal from a cheaper valuation. You might need a little bit of patience for that. But over time, we think that's the place to lay your chips.
Sounds good. I'm going to shift over to fixed income for a minute and go to Rufus here. There's a question here about, are bonds likely to break again? And if so, what would happen to the daily and traditional covered call world?
Thanks. So I think from what we've heard from Simeon and Bryan, there's reason to be optimistic for the medium term that this breakage of bonds is pretty unlikely, right? If, however, we do get into such a situation, I am not pessimistic or concerned about how that will impact covered calls generally. There's not really much connection between covered call strategies, monthly or daily, and how fixed income is doing. So I would not be too concerned about that. So luckily, we don't have to worry about that too much in that particular context.
Let's hope not. Bryan, I'll come to you. How will the anticipated Federal Reserve interest rate behavior impact bond yields in 2025?
Yeah, we still think the Fed has an easing bias here. So part of the reason is some parts of the economy have been disproportionately affected by higher interest rates, right? Such as lower income households, real estate, banking sector. And also the current policy rates are just above neutral. So eventually they will have to return to neutral. Right now, the market prices in just over 125 basis point rate cut for the entire 2025. And part of it is due to the policy uncertainties that's still with us today. Going into the year, we may get more clarity around that, which means we may see more rate cuts being priced in over the course of the year.
Yeah, who knows? We may see it next week, not throughout the year, but we'll see. I got a follow-up question here. How to approach duration and credit risk within fixed income portfolios as our audience is building these out for 2025? Is there something that you may think about when they're looking at their approach?
Yeah, that's a great question, Troy. So essentially, we think the focus of the investing in fixed income should gradually transition from one of building income to one of adding diversification. It doesn't necessarily have to occur today, as we're still seeing some pressures of rates going up, but it should probably take place this year. Again, bonds are more diversifying again, and then credit spreads are tight across the board, especially in lower rated credit. And then finally, in terms of interest rates, we mentioned that there's lots of policy uncertainties that can drive rates higher in the near term, but they can also become opportunities to tactically increase duration over the course of the year.
Great. I'm going to come back to Rufus. I think Rufus will be able to answer this question. What is the basis for investors' belief that covered calls reduce equity risk?
So I think the main driver of that belief is that you're getting that monthly, in most cases, monthly dividend or income from that strategy. So people reason, hey, if stocks are off a bit, I'm still clipping that coupon. Second, premiums from covered calls do tend to go up a bit when volatility increases. So people think, okay, well, volatility goes up. That's usually a down month for the market. I'll probably clip a bigger coupon and that'll help out. Unfortunately, drawdowns and real bear markets and corrections are path dependent. So it's not just one bad month we have to worry about. We have these cumulative losses that in most cases, when you look at the empirical distribution or the history of how these strategies have performed, if you have a bad month, it can help a bit. It's a bit of a cushion. But if you have a real correction or bear market, it's not much help at all. And we saw a great example of that in that first slide I talked about, where I talked about the global financial crisis and how those different portfolios performed. Hope that's helpful.
Sounds great. Rufus, and some of this is in that white paper that is in the resource piece, right? That they can refer to.
Exactly. Most of the slides we used today for my section came from that white paper we produced on, and it is available in the resource section. Thanks for bringing that up.
Great. And Simeon, I'm going to come back to you, and then I got one more for Kieran. So, is inflation risk a greater risk to stocks or bonds?
Bonds, for sure. And we've talked about this. It is the fixed coupon nature of the bond that puts it at most risk. The math is very simple. It's yield up, price down, and you just multiply by duration. So if we just saw it over the last month. You see a 50 basis point increase in yields on the 10-year bond. The duration is 7 or 8. Boom, you have lost 3 or 4% on your bonds. But equities are much different. Equities grow their dividends and earnings and can, particularly if a little bit of inflation is because the economy is strong, those earnings can grow nicely. And Kieran really did a nice job of pointing out how decent earnings growth was last year and how it's a pretty good environment for earnings growth going into next year.
Well, it's a good sign. Kieran, one last question. How do covered call strategies utilizing daily options differ from traditional monthly covered call strategies?
Yeah, it's an important one. And the old mantra, I suppose, Troy, is know what you own. So when we are speaking of our solution, our kind of proposed solution here on the covered call front, importantly, that is those are strategies that utilize short dated options like daily options. And the reason for that is because those strategies are much more likely to and have historically delivered more of that equity upside. So you're getting a 10% handle in yield, but arguably more important from a total return perspective is that we are targeting the returns of not just the S&P 500 with a product like iSpy, but also NASDAQ and Russell 2000 equity returns as well. So take a look at ProShares.com for all that product information.
Sounds great. And hopefully that kind of closes out here, but hopefully the last hour was really helpful as you kick off your journey into 2025. And hopefully we answered some of those questions, some of the things that we threw out at the beginning. But as always, as Kieran just mentioned, please don't hesitate to get in touch with us if you have any questions that weren't answered today, or if we can help you with that implementation of ideas. Our number is 866-PRO-5125, or you can email us at info@proshares.com. One of our ProShares service representatives will be more than happy to help you. With that, I'd love to thank the team here once again, Simeon, Kieran, Bryan, and Rufus, for their insights, and on behalf of ProShares, thank you so much for joining us. And with that, I will turn it back to Kristin for any closing comments.
Absolutely. Thank you so much, Troy, Rufus, Bryan, Simeon, and Kieran, again, for giving us an incredible hour, really highlighting everything that you were sharing, from equities to fixed income. I know that a lot of the folks that were here listening to this webinar, honestly, I think we're able to walk away with a lot of actionable insights. With that, I also want to thank the audience for tuning in for this hour. Again, as a brief reminder, a recording of this will be available tomorrow on ETF.com in case you want to look back on this, or you kind of want to take down even more notes from, again, that incredible hour of information. And that's all. Thank you so much to the ProShares team for sharing all of that information with us, and have a wonderful Wednesday.